Okay, I'm going to talk about several things. I'm going to talk about investing. I'm going to talk about give you a few examples of the kinds of investments that we have at TIAA-CREF. And then we're going to also talk about the economy, and then I will stop talking, and then you can ask me questions, and we'll talk about what you really came here to hear. So let's start with TIAA-CREF, a little bit of background. Got a great introduction. Their company was founded in 1918. We've been investing for the research and education community since that point. That's our sole mission, was then, is now. Nothing's changed. We've invested essentially the same way from the beginning of that period to today over multiple business cycles. We divide our business, and I'm talking to you from the TCAM side, which is TIAA-CREF, that's the TC asset management side. We divided up our business overall into the TCAM side and the Nuveen side. On the TCAM side, we have $640 billion under management. That's a lot of money. Enough to buy a couple of cars, I guess, a couple of houses. But we've been doing that for obviously a very long time, but to manage that amount of money, you have to have an overarching investment philosophy. You have to have a way of approaching investments in markets, because you can't put all of that into, pot-belly pigs. It's got to be a diversified and logistically thought out process, and that's what we do. And so I'll talk a little bit about that. Obviously, we have your typical stocks and bonds, kinds of portfolios, different kinds of bonds, whether it's government all the way to high yield on the spectrum. And then, of course, we have other types of investments as well. We have commercial real estate. We're one of the largest commercial real estate institutional investors in the world. We've been doing that now since the 70s or early 80s. You guys can probably tell me better than I know exactly. We've been investing in timber markets. We invest in agriculture. So we have investments on the slow but steady side, those that are less liquid, those that are not in financial markets. We have investments that are in financial markets. The idea being that you've got to diversify not only across asset classes, not only across regions, but also across different kinds of assets, not all of which are tied purely into financial markets. I get a lot of questions these days. We've had a lot of hiccups and a lot of volatility in markets today. What's going on in markets today? And we'll talk a little bit about that. But, is it the Chinese? Are they doing something? What's going on? I get a lot of questions about interest rate policy. These kinds of events, when they take place, always create uncertainty in markets. And so when you're thinking about this from an investment perspective, you really need to think holistically and say, okay, we're going to be in different cycles. You saw a timeline on the last graph. We've been there for a long time, and we want to be there for a long time, which means you have to really think about investments across multiple business cycles and multiple periods of uncertainty. Okay? So I'm going to get real technical here. I'm going to try to be as gentle as possible. Raise your hand if you don't get something. But generally speaking, there is a good positive relationship between the volatility and the return of an investment. So the more risky an investment is, the more you should be able to make from that investment, right? So if I'm going to take a risk, I might as well get paid for it, right? So there's that positive relationship. But there's something interesting here. Look at the top leftmost one that says farmland. So the right axis there is volatility, that's risk. And the left axis, that's return. So this is how much I'm making on average in this type of investment. Okay, farmland investment has a unique characteristic. It's an example of something that we have investments in, which I'll talk about, that has a low volatility, and there's lower risk, but has a fairly high average return through time. And why would we want to be in there? I mean, why would I want to own farmland? I'm not a farmer. Last time I checked, I'm not a farmer. But yet I've gotten my boots and jeans on, and I've gone out and gotten dirty looking at these things. Why? Because when you think about the broad portfolio, you really need to think about different assets, okay? We've been investing since the early 2000s in farmland. When the financial crisis hit in 2007, 8, and 9, what happened to financial assets? What happened to the stock market? Well, we all know the answer. It went down, right? And it didn't matter whether you were invested here, whether you were invested in bonds, whether you invested in Europe, in emerging markets, pretty much all financial assets, the correlations went to 1, and they all dove off a cliff together, didn't they, right? Well, guess what happened in the farmland portfolio? Not a single credit loss, not a single mispayment, not a single hiccup in the income stream that portion of the portfolio provides to our participants. So here you have an example, a really a live, breathing example of how you really need to think about this portfolio and put it on different axles so that when you hit a pothole here, it doesn't necessarily vibrate the returns in the long run. So let's talk a little bit about this concept of farmland return. And this is just an example for you. So we'll do a couple slides here, then we'll get to some economics as well. But if you think about correlation, in other words, how do investments behave relative to other investments, you find that a lot of financial assets, and every advisor will tell you, it doesn't matter who he is taught, this is financial advising 101. Diversify your portfolio. Don't put all your eggs in one basket. I mean, how many of these kinds of things are there out there? How many of these little sayings are there out there? But in times of crisis, the correlation of liquid financial assets tends towards 1, and they all tend to behave in the same way. Now, so there's 2 things you can do. 1, you can not invest in financial assets, or if you will, diversify away from only financial assets. And 2, have an investment horizon that is longer than tomorrow, okay? So don't make investment decisions based on the fact that yesterday's stock market was up 200x points, and 2 weeks ago it was down 5%. Don't make investments, long-term investments, because of those short-term gyrations in markets. You need to invest over multiple business cycles. You want to live a long, healthy life, and you want to have enough money to provide for that long, healthy life. So that's where you need to be, and that's how you need to think of markets. Well, we do both. Obviously, we invest for the long haul, but we also invest portions of the portfolio in different kinds of assets, farming being one. So if you think about farming, okay, what is farming? Farming is food, it's dirt, it's a lot of sweat, especially here, and I live in Houston, so we have a lot of sweat for us in Houston. But you have something else. You have a growing population, and the last time I checked, everybody wants to eat. There's a very, very consistent supply growth, demand growth in food related to population. In addition to that, around the world, a larger and larger percentage of people are actually moving into the middle class. Now we think, wait a second, middle class, what is that? 30,000, 20,000, 50,000. What is that here in the United States? That's those kind of the numbers we think about when you poll people, when you ask people. In China, middle class is like $4 a day, okay? In Africa, it's about $1.50 a day in wages. That's middle class because, you know what, they don't have a 7-Eleven on every corner and a gas, and nobody has a car, and those kinds of things that actually soak up a lot of money, right? And so if you think about people moving into the middle class, what do people do? How does the behavior change when they move into the middle class? They eat more meat, they eat more protein. They go from a grain diet to a protein diet. Well, guess what? It takes about 4 pounds of grain to raise 1 pound of beef, of protein. So now you have more people demanding protein, which means you have an exponential increase in the demand for grain. Farmers, let's be grain farmers. There's a future in grain farming, I tell you, okay? But this is what it is. And so the correlation, when you think about farming, the correlation is to the CPI, it's to inflation. It's not to what the price of GE or Goldman Sachs or anything else, or ExxonMobil, right? It's not, the correlation isn't to another financial asset, the correlation is to life, which is a little different. Okay, so we set about a strategy whereby we are going to invest in agriculture. We're going to be if you will, we're going to be a renter, a homeowner. We're going to have a rent portfolio. We're going to buy land. In this case, you could buy a house and find a renter. We're going to buy some land and find a farmer. And so these are the major grain-producing regions in the world. You got the United States, you got sections of Latin America, Australia, sections of Russia. We don't invest in Russia. But those are just where you would find good soil conditions, good output, good metrics, and those kinds of things. And we wanted to balance the portfolio. So we want diversification within this portfolio as well, right? So what if there's a huge drought in California? There is. Okay, what is that going to do to returns? That might actually hurt returns, but guess what? There's still the same number of people. They're still eating the same amount of food. So if you have issues in one segment geographically around the world, you can actually diversify an agricultural portfolio by investing in different regions. So where there's a drought somewhere, there's excess water somewhere else, and you get a balancing effect in an agricultural portfolio if it's built correctly. And so we've made investments in the United States, we've made investments in Brazil, we've made investments in Australia. The second criteria is we want these to be core properties. We want these to be safe, secure, low producing, but very, very stable and steady. This is a foundational kind of investment, and it has to be long term. But we want to invest in countries that can provide for their own population, that are economically and politically stable, and have a thriving export relationship with the rest of the world. And that's why America's on there, Brazil's on there, Australia's on there. Russia's a little questionable these days, so we'll stay out of there, okay? Now you might ask me, okay, so where exactly are you investing? Do you mean really, Tim, that you buy land? And I'm telling you, yes, we actually buy land. We have a subsidiary of farm managers, and that's what they do, boots on the ground. These guys don't wear suits, right? And they sit there and they source, manage, and help us get rid of deals when we need to make portfolio changes. But you can think about this all along the value chain. Now I'll tell you, we invest in row crops, but we don't invest in grain. We don't invest in futures markets. We don't influence markets. We don't want to participate in markets. It's not what we're here for. It's like buying a house and finding a renter. We just want that income stream from the land. And so we find good relationships and build good relationships and contracts around those lands to have stable renters for long periods of time. So we do that. That's the primary input. We also have some processing in other agricultural sectors. So we have some processing, for instance, of almonds and pistachios. So we do that kind of thing. So we can own a processor. We can also own distribution, transportation, infrastructure kinds of networks. So you grow, you process, and then you get the food to market. But in none of those areas are we owning the actual produce itself. We don't want to influence the markets. What we want to do is provide an income stream which is stable for our participants. So I'll go through pretty much this. Another thing that we do, which is related to this portfolio, is not really investing. This would fall into the category of investing into people and communities. And part of our California portfolio in the agriculture sector, some of our portfolio is more labor intensive. And we found that we started a pilot program where we were working with an employment agency which finds jobs, finds employment for disabled people. And we found is that we can train and provide a stable labor force for the agriculture sector, and this pilot program is running in California, but for the agriculture sector, and it's a way that we can give back to the community. We can be a stable participant and a long-term participant, one that gives back to the community, and we're providing employment and jobs for an underserved segment of the population. But what you really find is that this stable labor force becomes very dedicated, and labor force turnover rates, in other words, migrant workers and people coming for short periods, you don't have the costs of finding and training employees. And what you find is that the profitability also improves at these facilities where we've started this program, Fruits of Employment. So it's really something where we can give back to the community, but at the same time, it provides also better profitability and more stable returns for those fields involved. So it's a way that we interact. This is a philosophical issue for us. We believe in supporting the community and interacting and reaching out to the community. And in as much as we can, we do that as long as the fundamental goal is met, which is that long-term stable income stream. So this is an example. There's a couple of slides that talk about that, which I can address if you have any questions as well. Okay, the next thing I'd like to talk about is the economy. I'm an economist, so I can't come here and not talk about economics. And here, I hope there's a lot of questions. At the end, we'll talk about the economy, where it stands, where it looks like it's going. We'll talk about interest rates. We'll talk a little bit about market volatility. And then, like I said before, you can ask me what you really want to know from me. Okay, so where are we? And where do we stand right now? This has been a very weird, there's no other word for it, recovery. Typically, you see a recession followed by a recovery, and it's something, if you would look on a graph, more akin to a V. So you look at GDP, you look at the economy, you look at employment, you look at profitability, you look at wages, incomes all across the spectrum. You're going to find that similar pattern of falling into recession and then recovering from recession. And that looks like roughly a V. What we've had here is more like a check mark. You've had recession, and it was a bad one, but not the worst. And then you had this recovery, which is kind of like this. It's been very slow. It's been very anemic. It hasn't been very, interesting to people. People read the headlines, and they still feel like things are not going very well. And there's really two things that are missing here to make this more of a normal recovery. More consumer spending. So clearly, you guys are watching me rather than going out and spending money. So feel free, go ahead, spend money. Clearly, it's a lack of consumer spending growth and a lack of business spending growth. Businesses have been focused on improving their businesses, becoming more efficient, getting rid of debt, or lengthening or lowering their debt payment structures. And consumers have basically been doing the same thing. They've been lowering debt. They've been lengthening their debt because interest rates are low. I'm going to take advantage. I'm going to try to lock this rate in for a long time. And that's the story that you hear over and over. It's not about, hey, this new job I got. Hey, this raise I got. Hey, what did I do? Look at the opportunity. Look at this company I started. Those kinds of things. You don't hear those kinds of stories in this recovery. And the reason really is because there's been a very strong, there was a very, very strong buildup of excess demand, which led to labor supply increases, housing supply increases, increasing in production capacity, factory floor space, that kind of thing, across the economy. And we had such a strong downshift in activity that there is this excess capacity in the economy in almost every sector uniformly, especially in housing, but uniformly across the economy. And so now that you have all this excess capacity, and you have improvements. So we've come along, a long way, but we're not there yet. You have to eat up that spare capacity. So if I'm a company and I need to increase my output, and my factory is at its limits, I can't hire any more people. I've already on 3 shifts, and yada yada yada. I need a new factory. Well, am I going to build one, or am I going to go rent one, or am I going to go buy an old, dilapidated one and spend a little bit of money to fix it up? Those are much cheaper options. And so that's exactly what I'll do. So we've been eating up capacity, but at a very slow rate. And that's the underlying reason of why this economy and this recovery has been so weak to date. I use the analogy sometimes that, we used to drive down the road, but now we're walking down the road. It doesn't mean that you won't get to your destination, but it does mean that you're going to get there a lot slower, right? The difference in the speed really has an effect. And that's really where the economy is today. The economy is walking down the road. It's still going to get there. It's just going to be really, really late. Okay, so if there's 2 things that you really need to do, you need to increase consumer spending, or you need to watch for it, and you need to increase business spending, all right? Those are the 2 things we're going to be watching for. So I've been writing for about a year now. Okay, it looks like we're getting close. It looks like we're getting close. There's inflection points in the data. The data's starting to turn up. It's not in the headlines. It's not sort of common knowledge. It's not the kind of water cooler talk conversations that you would have. Not yet, but it's coming. It's coming in the data. So the red line and the blue line here is a measure of sentiment, okay? How do people feel about their situations? And the amount of durable spending. So how much money do people spend on durable goods, okay? So imagine this scenario, right? I'm a machine worker, right? My wife is a teacher, right? We had a great job. I got a raise. Things are happening. We bought a new house in 2005. Kids are healthy. They're now in high school, and everything's good. But then the economy hits hard times. I get laid off. My wife, she's still a teacher. She didn't get laid off. We also noticed at the same time that we had a lot of people kind of got laid off. I know a lot of people. Housing sales kind of started to slump in our neighborhood. Housing values went down. I didn't feel too good about our situation. We stopped taking vacations. We didn't have enough money, right? This is a very common story across the country. That guy, we'll call him John Smith, whatever. John Smith, he gets a job. He might have got a job, but it's for less pay. It might have not been in the exact industry or skill set that he was there, but he had a job, right? Fast forward 2 years later, he switched jobs again. He's now back with a company that he knows. He has gotten a pay raise. He likes the new company. He's got good management. He feels more secure. Guess what? At the same time, about now, home prices are starting to move. Why? Because people are getting jobs. And in fact, home values are starting to increase. Again, you see more home sales. It's creeping, but it's moving in the right direction. And you look back at the last 6 years and say, man, that was a nightmare. But it's over. It's gone. I'm feeling a little better. My kids are now through college, and it's feeling a little better. And the wife comes to me and says, honey dear, we've been living on this refrigerator, which is on the fritz and has been. And we keep calling Joe the repairman out. And guess what? It's time for a new one. Oh, okay, honey, I think we can afford it here. We actually were able even to take a vacation this year. So my sentiment, my feeling about the economy is better. And the behavioral difference there is people start spending money on big ticket items. That's the difference. We're starting to see that inflection point. You can see a little bit. It's not a lot. And so we're in that phase now where you look at the inflection points of the data and you say, is that a false start? Is that just a bump? Is that a ha, gotcha? Or is that really a change in behavior? And we're kind of in that environment right now when you look at a lot of data. It boils down to the fact that consumers are, in spite of the fact that they don't feel completely healed or over the past 6 years, they're starting to feel better. Wages are starting to creep up. Several measures, not all, but several measures are starting to see increases. And employment is starting to increase. That's the right graph. Employment is now averaging over 200,000 jobs per month in jobs across the country. That's a good sign. That's a good number. And we don't really need more jobs than that. And as long as that continues, we're moving in the right direction. If we think about the business side, right, businesses have the same kind of feeling. If I'm a business owner and I see that I need to I need to increase output because I have more customers, or maybe I'm able to raise prices a little bit, I'm going to start hiring, and that's what they're doing. So on the left side, you've got the unemployment statistics, and you've got the unemployment, the weekly unemployment numbers, the newly unemployed, and which is an inverted graph. That's why it's on the left graph. On the right, it's going up. That's really a good thing, not a bad thing. I inverted it so you can see the relationship between those two lines. And then at the same time, you've got the sentiment index for businesses. So they survey small businesses across the country, 5 million of them every month, and say, okay, do you need to hire more? Do you want to hire more? Do you not want to hire more? And then they tabulate those results. And there's a very good correlation between businesses feeling the need that they need to hire more and then laying off fewer people. Well, that makes sense, you would think. Okay. On the right side, I've got a metric that I sometimes use when thinking about how close are we to full employment. And the important thing here is that you really need to know is when it spikes and it goes to 100% and then it starts to back off, you know that you're within a year of full employment. Now, what is full employment? Why do I care? And what does it mean? Full employment does not have to be a difficult concept. It simply means that labor markets are balanced. It means that anybody who wants a job has a job. That's what it means. It means that there's no unnecessary, and of course this is an economic theoretical concept, right? So we have to be fuzzy and simplistic around the forecasting of these kinds of numbers. But the concept is really simple. It's anybody who wants a job has a job, okay? And we're reaching that point. We're actually getting there. The economy has been walking down this road. Yes, it's slow. Yes, it's not the way we want it to be. It's nothing to write home about, but we're still getting there, okay? We're still getting there. And that's the point. And this indicator here has actually been one of the strongest ones. And it goes back to the early 1980s, and every time it's peaked and then come down from that, you've seen an improvement in labor markets. Okay, so why do I care if we're at full employment? What does that mean? If everybody wants a job who has a job, hey, that's good. I'm happy. You're happy. We all have jobs, or at least those of us that want jobs. Guess what? It never stops there. It always goes through there. It's a pendulum swing. This isn't some magical number where everybody in America wakes up suddenly and says, hey, we've reached it. We've won. Okay, relax. No, it doesn't work that way, right? It keeps going. It's a pendulum swing. So you don't stop at full employment. You go through full employment. Well, what does that mean? If you go through full employment, it means that there's more demand than there is supply, so wages have to go up. So I know that when that thing peaks and starts to come down again, I know that wages are imminently going to start rising across the economy. Broadly speaking, they're going to be going up. And I can't speak for anybody in this room, okay, or even myself. But I know that they will be across the economy, all right? And in fact, we're starting to see that inflection point in wage data. So if, broadly speaking, everybody is generally fully employed and their employers are so worried that they might lose their employees because it's real hard to find employees now, that they start giving out wage increases, guess what? Wages are going up. What happens when you have money in the bank? You buy a new refrigerator. That's what we're talking about. So it creates a cycle where your wage increases say, well, I want to go on a little nicer vacation, a little longer vacation. I want to paint the house, not just buy that refrigerator. I want to do things. And that creates demand for businesses. Those businesses say, hey, my demand's going up. I got to hire more people. It creates a cycle. Why is that about? I'll skip the foreign segment. It creates a cycle that leads to rising wages and ultimately rising inflation, okay? The Fed looks at that and they say, I'm glad the economy is going in the right direction, but I don't want it to get overheated because we don't really want inflation. So we want a moderate amount of inflation, and their target is 2%, okay? That's really what they're going for. They're going for growth, but moderate growth. And they don't want these cycles to get out of hand. So they start raising interest rates. That's where we are today. So here I've got the forecast for the U.S. economy. On the left is really the important one that you would talk about. And then 2014, we grew at an average rate of 2.4%. In 15, we're going to grow at about the same rate, 2.4%. I got a question earlier. What's it going to be next year right at the election? It's going to be about 2.4%. It'll be actually a little higher, 2.5, 2.6, but nothing really to write home about because we're at the beginning stages of a real acceleration in the recovery. Some of you might have heard the expression, the Fed takes the punch bowl away from the party right at the time when the party really gets going. Some of you might be aware of that expression. That's kind of what they're doing, right? They're going to start raising interest rates because they don't want the economy to overheat. But that's okay. That's normal. This is a cycle, just like any other, except for it's a little different. Below that, I've got forecasts for other regions that we invest in. There's China, Eurozone, Japan. Those are just big regions that people are interested in, and I do forecast those regions as well. Okay, so we know where the economy is. It's on a dirt road, but it's really close to its destination. We know that the economy is going to pick up, and it's going to start accelerating. We know that the employment is healing. We know that people's home values are starting to improve. We know that jobs are starting to spend money on factory and output, and they're starting to hire more. All right? So we know now that the Fed is going to have to start raising interest rates. Now, this is a complicated graph, but I'll try to break it down for you. The blue line at the bottom is the Fed funds rate. That's the shortest rate that we can think about. That's the Fed. The Fed sets that rate, okay? The 2-year Treasury is the red, And that, well, let's call it green to be politically correct, is the 10-year Treasury notes. Anybody invested in government securities, that's the 2-year security and the 10-year security. And you can see the blue line kind of tends to push and lead, nudge those rates. So when the Fed starts raising rates, it's really only raising the short rate, the Fed funds rate. But that tends to ripple through the economy. If the Fed raises rates, that means banks' base rates are now more expensive, and they have to push on those costs to customers. That's you. So then you have to, when next time you want to buy your house, boat, car, whatnot, that is then means that your rates get pushed higher. And so you can see cycles. Here's back to 1983, but you can see the general trend that's been coming down. Even in up cycles, it's been coming down. But what we look at is the gap between the red line and the green line. That gap is generally widest during recessions and immediately following recessions, and it's the narrowest at the peaks. And you can see in the 2006 time frame, it actually inverted. That means that the Fed funds rate and the red line are above the green line there. That's the peak of the business cycle. Look back to 1999, peak of the business cycle. Look back to 1988, 89, peak of the business cycle. We had recessions in 1990, 91. We had recessions in 2000. We had a recession in 2008, beginning of 2009. Those are the peaks, all right? So we're starting the process of raising rates and slowing the economy down because we're starting very slowly to get to the point where the economy is really starting to accelerate. And that's a good thing because we all want jobs, we all want pay raises, and we all want new refrigerators. We found that out today. So the difference between this rate hike cycle and the typical rate hike cycle is that this one will be slower. This one will be slower, and it won't go up as far as the last one. There's still a lot of excess capacity in the economy, so the Fed needs to raise rates, but they probably don't need to raise as far or as fast. So they're not going to. Well, so they tell us. I don't work there anymore, so you can't. Don't call me. But anyway, so that's where we are. And then here, okay, let's talk about the top 2 points, and then we'll kind of move on. If you think about, I'm a forecaster, right? I'm an economist, so I've got to come up with a call for our company. This is what the forecast is. It's 2.4% in the U.S. economy. And so then my boss comes to me and he says, well, are you going to be right this time? And I say, well, Bill, I'll tell you what, I'm going to be right with some small fine print. This is the fine print, okay? So what could drive that risk, or what could drive that forecast to be different than I think it is, all right? You have domestic risks and foreign risks. I'm just broadly kind of categorized them. But the wage growth might be a little softer than we think, and so therefore the Fed says, well, I'm going to raise, but I'm not going to raise in September. I'm going to raise in December. So they push off when they raise rates. So that's kind of one reason. They might say, spending. So wages don't necessarily rise as fast as I think they might rise. And so therefore maybe spending doesn't go up as fast or as much as I think it would, or when I think it would go up. And so there's reasons whereby the economy might be just a little slower than 2.4. It might be 2.3, 2.2. Those are the kinds of fine nudging and fine touch points on a forecast. Those are not really big points because, frankly, am I really wrong if it's 2.3 or 2.5 versus what I said it would be at 2.4? Yeah, I mean, you won't notice a difference. You won't feel any different in the economy. Foreign risks. Generally, geopolitical risks are a little different in the sense that, yes, they can affect your forecast. So, slowdown in China, less demand for our exports. That bleeds through to our economy. Our economy's a little slower. Okay, got it. Good. I can get there. But then there's the other ones, right? We've got an Iran nuclear deal coming. And so there's a lot of people who are scared because we don't trust the Iranians. We have the Russians who invaded Ukraine and took over the Sevastopol port, which is a military naval base for the Russian army, but it was rented from the Ukrainians, and well, now they own it, I guess. There's these conflicts that keep popping up. There's ISIS. There's the tensions in the Middle East. There's China, which is expanding its naval territorial waters in the Far East. All these things are happening, and so we have to think about what's the percentage, what's the risk that something that would actually come derail the economy? And so there's a few things out there, but nothing really stands out as being detrimental to the US economy. It's really more of the nudge factor. Most of these risks are really just, yeah, if they really flare up, okay, it'll slow things down, and that just means that we're going to raise interest rates, but maybe not now, maybe it'll be next year. It's that kind of thing. It's not really going to change the way we think about things. The final question I get a lot these days, especially in the last 2 weeks, is the stock market has been crazy. What is going on with the stock market? Please tell me. I mean, look at this. This is just the S&P Standard & Poor's 500 index, and I've got a log index. I've got a log measure on the left, so don't worry about that. It's flat. In fact, the peak there is May 23rd. That's when it peaked at 2130. And it's kind of gone sideways, maybe a little bit down here for about 3 months. And then it fell off a cliff, okay? What's going on? Are all my investments, is my retirement safe? What's going on? There's a lot of things going on. Technically, what caused this was a change in policy in China, which caused a shockwave over to other emerging market countries, which then kind of grew. It kind of, like a tsunami, right? It's got this wave underwater that you can't see, but when it gets close to Hawaii, all of a sudden it's this, 100-foot wall of water. That's really kind of what happened. You had this shock wave, which went through emerging markets. It really caused a lot of problems over a short period of a week or two in those countries that blew up then to developed markets. So we had problems in European markets. We had problems in the US markets here. And this is what we saw. This is what we saw. This is the 100-foot wall of water that we saw, and it caused an intraday 14% drop in the S&P on Monday, September 24th. So that's the bottom right there. Okay, those are the possible causes. So people come to me and they say, okay, so this is China. This is an emerging market problem. This is a China problem, or is this somehow an impending doom of the U.S. economy? So really, this is just the tip of the iceberg, and really the American economy is what's going on. And then some people come and say, no, it's the Europeans. The European Union is in trouble. They're going to fall apart. That's going to create havoc. And none of these are responsible for what we saw in the stock markets. None of these. These are things that there is no systematic time bomb ticking in China. There is no systematic time bomb ticking in emerging markets or the US economy or the European economy. What you have in a worst case scenario is an economic transmission to the US economy from some problem around the world. So let's use China as an example. There's a problem in China, or if you think there's a problem in China, there's not really. They're slowing, but they're not going into recession. The U.S. economy is very insulated. It's very insulated from China in particular, but it's actually rather insulated from the rest of the world. The U.S. economy exports, exports represent about 13% of GDP for the United States. So exports is other people demanding our goods. We're sending goods overseas, right? 13%. China is 7% of our exports. So if China goes down, let's say 10%, that's a pretty hardy number. That represents 0.04% of GDP. 0.04%. That's nothing. Okay? Nobody in here is going to feel that. Same thing with other emerging markets. Same thing with individual European countries and those kinds of things. The key point really is that what matters for the U.S., that's the bottom line, what matters for the U.S. financial markets is U.S. economic conditions. And we've already been there. We're walking down a road. We've got a lot of slack in the economy. We're not driving. We're walking. And that's not special. It's not something to write home about. But it's also fundamentally sound. And that's the message. It's fundamentally sound. And that means the financial markets in the long run are also fundamentally sound. So here's that same graph. But I've put it up against 2011. Does anybody remember 2011? Come on, it was 4 years ago. We had a 15% drop in the stock market 4 years ago in August. Does anybody remember that? Some do, most don't. Most don't. 5 years from now, 10 years from now, we're going to look back at August and September of 2015, we're going to say, oh, stocks were on sale, I should have bought more. That's the philosophy that you have to have when you're investing for retirement, for pension benefits. You cannot be focused on the short term. You have to be focused on the long term. And if you're going to the mall and you're buying a new suit, right, new pair of shoes, and you go to the mall and you say, I really need that, I'm going to go buy it, and you go there and lo and behold, they're having a big sale, hey, I'm happy. That's what this is. That's what this is. Okay, that's what I just said right there. It took entirely too long to say it. We have a few minutes for questions.
Yes, let's take questions, and if you please raise your hand, and we'll get the microphone to you. Yes, sir, right back here.
I know that TIAA-CREF has a lot of money invested, and I'm wondering about the age of the participants. When they reach 7.5, that's all going to have to start coming out. The proportion of the assets in relation to the age of the participants. Can you give us a picture of that? Is the anaconda going to have a population bulge moving through it?
The anaconda is not, the swallowed pig is not towards the tail of the anaconda. Well, that's also why I'm here and why we have the efforts to go out and ensure and make sure that we have a continuing stream of new participants, right? I mean, that's what we do. And yes, you do have, as an individual, a lifespan, and you have a period where you're paying in and then a period where you're taking out. Fortunately for us, that's rather evenly distributed along the spectrum, and what you see is that we can manage with a asset liability process. Not only do you manage the diversification of the portfolio, but you also manage the diversification of the participant base. And so you can manage the payout stream that are required. So when do I need to sell something? That farm in Brazil that we bought, right? So when do I need to sell that so I can pay your benefits, because I know you've been stocking it away, buddy. Okay, that is also part of the calculus and the actuarial process, right? But we're fine there. It's actually a pig. It's a snake that's very happy. He's got a lot of pigs in him.
Yes, Leo, right behind you, Bob.
Thank you for coming. Greatly appreciate your time. My name is Silo Joshi. I'm a first-year Clinton student. My question is about the LIBOR and the scandal in 2008, 2007, and
Sure.
with Barclays in 2012. With class action lawsuit coming to Barclay, or at least in the possibility. In regards of being a student, what do you think the impact of the LIBOR and the scandal that has currently happened on student loans and the next 10-year prognosis of the impact that we will face?
Yeah. So the last financial crisis was a combination of excess demand and excess construction in the housing market, along with excessively liberal financial market manipulation as it relates to financing of those houses. And so you would roll this stuff over, and pretty soon you had investors who were investing in something that really was not related to the house, right? It was this very murky situation of excess investment in a sector. That process, that in a broad spectrum, has created a pendulum swing in regulation, a pendulum swing in scrutiny on financial institutions, the markets, et cetera, those kinds of things. And that has led to the shrinking of that industry. That's actually one thing, and that's an important conclusion that we've seen. We've seen it rather dramatically, probably more so in England than here. The Europeans were much stricter in their regulatory changes post-crisis, especially the Brits. And the continental Europeans did other stuff, but equally as tight. Then we have the LIBOR scandal. You have another scandal, which is the London whale. And all of these issues hurt the bank involved, or the institutions involved. And yes, they've got legal fallout and claims and those kinds of things, but they're less related to the industry as a whole, okay? And so their impact on the industry as a whole is much smaller than the broader crisis. The LIBOR event is less related to student loan debt and the amount of student loan debt available, but the there is an increase in student debt, right? So if you look at balance sheets, consumer balance sheets, there's an increase in student debt, but it's not to the levels that are crisis, that we would call crisis levels in, like what we saw in the housing market pre 2005, 6, and 7. So, is that the next bubble? Well, when there's a crisis, people tend to look at what just happened, the cause of that crisis, and say, okay, I've got my bubble glasses on, and I'm looking for the next bubble, and it's got to be related to financial markets and bubbles, because that's what the last one was. And so the temptation is to look at, okay, there's too much student loan debt, there's too much car loan debt, there's too much of this debt, so there's a debt bubble going, there's got to be, because there was here, so there's got to be now. The next recession is not going to be a student loan crisis, debt crisis. It's not going to be a car loan debt crisis. People are actually saying this is going to happen, but it's not. It's going to be somewhere else. It's going to be in some other sector, in some other business, probably not finance. It might be in another country, which bleeds over to this country. So it's too early to tell. I'm not smart enough. If I knew, I would be shorting that business, and I'd probably be on my own private island somewhere, right? So I don't know, but it's not going to be in student loans.
Ron, right here.
How much is climate change influencing your long-term perspective or projections?
Great question. We have a history and track record of investing in an environmentally neutral manner. This is especially true in our farmland, but it's actually in most of our investment philosophy. We're signatory to the charter signatory to the United Nations responsible investing guidelines. We helped bring them about. We helped determine them and signed on to them, and we follow them very, very rigorously and to a T. If you think about, and when I was talking about the farm investment area, that's really an investment in water, right? And we think about balancing a farm portfolio around the world. You've got droughts in one region of the world, and you've got excess rain in another region of the world. But you've got to balance out this portfolio so that all your eggs are not in one basket. And so if all your eggs are in California, then you have a drought, and if they're in those affected crops, then you've got problems in your portfolio. So we need to diversify that out, and we're doing that actually with that part of the portfolio, because in as much as there is climate change, then from a we have to feed the world perspective. Let's just assume that catastrophe happens and it stops raining in America, right? All the farmers go out of business. That land goes idle and worthless and that kind of stuff. We still have 7 billion going on 9 billion people to feed. They're still eating the same amount. We still have to feed them. So what does that mean? Well, it means that agricultural prices would go up, right? But it also means that returns on another part of that portfolio would actually go very high as well and compensate you for the losses on this side of the portfolio. And that balancing, that's really what we're doing, is diversifying the portfolio to manage, in that particular case, that exact potential.
Yes, sir, you had a question right here.
Yeah, I was just going to ask you about rising interest rates. If the interest rates are going to rise, can you explain how that would affect the national debt?
The national debt?
Or the interest on the national debt?
Interest on the national debt. Well, it's going to go up. Absolutely. But it's been coming down. The interest payments, on a per unit basis has been coming down for the past 9 years. And the next cycle it goes up. But it's that way in every cycle. But yes, it will go up.
We have a question right here. Yes, sir.
Hi, we've kind of touched on them a little bit, but I was just kind of curious if you could talk about not your like black swans, but your kind of dark gray swans. Like, what are the things that you're like?
They're baby black swans.
Yeah.
There's nothing on the radar scope domestically in the United States. There's no LIBOR scandal. You've got regulatory issues, and you have this and you have that, and everything kind of affects your forecast on the margin. But there's nothing really that looks like it could grow into a mama swan. But we're always watching it. Overseas, you have to be wary of the politics, the geopolitics, and the political changes. I had a discussion earlier about China. And if you think about China, we don't know much about China. In the West, we don't know much about China. We look at China, it's very opaque. We don't understand it. We want to understand it, but when you view from that perspective, I mean, just think about your own situation, your own life. Somebody moves into the neighborhood, you don't know that person, and then he starts doing something that you think is odd. So you eye him suspiciously until you get to know that new neighbor, and it turns out they were just gearing up for a new potluck dinner, and they were inviting all their neighbors over. We view China with suspicion because we don't know them. They have a different culture, they have a different regime, a different language, a different history. And so we look at China and we say, they devalued their yuan on August 11th. How dare they? They're creating ripples all over. And so we have to watch for these things. But in the case of China, what you need to do is you need to step back and realize what is it that they're really trying to do. They're trying to take an agrarian economy that was primarily farmers in the 1970s and move it to a manufacturing economy, which is what they basically accomplished between the 1970s and the early 2000s. They joined the WTO, and they decided they wanted to industrialize and become the manufacturing hub for the rest of the world. And then the new guy comes, and they have 10-year presidential plans. The new guy comes in and he says, that's not going to be good enough. We need to create growth. We have a rising income population who wants to change their consumption behavior. Why can't I get iPhones for my people, right? They didn't sell iPhones there, right? And you have people inside China wanting iPhones and nice cars and nice things, just like anybody else does. And so they're trying to take a system which is primarily designed for manufacturing for someone else and turn it into a system which can also cater to a portion of their population which has the means to buy middle income type items. And that process, that transition is scary because, by the way, no country in the history of this green earth has been able to transition from an agrarian to an industrial to a, not even the United States, to a world leading, whatever you want to call it, developed market. No one's been able to do that without some form of crisis. Is it a recession? Is it a political crisis? Is it an economic crisis? We had the Panic of 1907, and because of the Panic of 1907, we now have the Federal Reserve. So it's not like it hasn't happened here. But we have to kind of step back and say, what is it that they're trying to do? And then actually help them do it. Of course, they're proud, they want to do this, they want to kind of do it on their own, right? Mom, I don't want help on my homework. That's what I used to say when I was little, right? This is really how you have to view China. And so when you look at these instances, and all you get is a headline, China devalued, China did this, China did that, you have to look, what did they really do? They didn't really devalue their currency. What they really did was change the way the currency peg is designed every morning. So they have a managed peg. So the value of the yuan, the renminbi, is this, and it's this because I set it, because that's how the People's Bank of China, the central bank, sets the rate every morning. They do this every morning. They set it. And what they said is, I'm going to now allow the market to set that rate. And so that created volatility. Of course, the renminbi is a little bit overvalued, so it came down 3% very quickly that week, and now it's kind of bouncing around. And they've backed away from that policy a little bit because there was too much volatility. So it's kind of like the Chinese are letting the rope out a little bit. They want to free their economy. They want to liberalize their capital accounts, their currency, their interest rate markets. They want to, but they want to do it slowly, because if you just let that rope go, you don't know what's going to happen. And they're nervous that all the capital in the country would flee, and then they would have a real crisis. And so they want to do this slowly, and that's what they're trying to do. Now, on the receiving end, all we see is the headline that says they devalued. They didn't, but that doesn't matter because nobody heard that. And that's the thing you watch for. That's what I watch for. Is Greece going to exit? I don't care if Greece exits. Economically, it's, I tell people, Greece's economy is half the size of Houston's economy, okay? Half the size of Houston's economy, not even. That's what we're talking about. If they leave, is it really going to matter here? No, we don't care. Let them do whatever. However, it will impact stability in the financial markets in Europe, which matters to us as investors. It matters to financial stability. Is that going to overflow? Is the nervousness going to overflow? So we need to watch those things. So when these things appear, I'm front and center looking at and trying to make the decision and the call, if you will, on whether or not Greece is going to leave the Eurozone. My answer was no. What's happening with the Chinese? This devaluation was much more related with a technical policy with the IMF, really, rather than them trying to muddle around or change their currency or devalue or something like that. Okay.
Well, I know there are more questions. You will need to come up and visit with Tim at the conclusion of this. Let's give him a round of applause. This is